If you are a margin user and you're down 25% on the last 1 month because you're in the high yield dividend community, or if you plan on getting into high yield dividend community and you plan on using margin and you don't want to be down 25% in 1 month, then I recommend you watch this video because it's going to be very informational on margin. So, margin for the high yield dividend community. A TLDR is information on margin, as many people are currently being humbled with the market correction. How many of us said, I'll buy high yield on margin and it'll pay down the loan? I was one of them. I will give examples of issues and shortfallings using it and how to navigate it better next time, but more strategically. I want to be clear, do not be afraid of margin because of this market correction. A lot of us were ignorant, but margin is still a useful tool. Everyone can use it, we just gotta use it better next time. Before I go over everything, I want to be clear, every broker is different. Do your due diligence on your broker, even call them up because this is very critical. I'm biased, I use Robinhood, but they really do seem like the easiest to use without, any margin headache. And what I mean by margin is different on brokers is with Fidelity, for example, allegedly, because I don't use them, but I hear people say it works based on concentration. So the more concentrated your stocks are in a margin account, so like portfolio allocation of that stock, the higher the maintenance / limitations there are on that account, or at least maintenance wise. And the biggest one is IKBR, because I know for certain that IKBR, there's no margin call, guys. It's auto liquidation at the end of the trading day. At least with Robinhood, right? So you can click the buying power, and then Robinhood makes it really, I guess, brain dead, right? You got low risk, but mainly it gives you your margin buffer, 54%, $70,000. If your account drops $71,000, I'm $700 in a margin call. And the thing about margin call is we all heard stories of margin call and thought it was bad, but really a margin call is good in the sense of you have a safety net, right? With Robinhood, you got 3 to 5 days where you can A, deposit money, B, sell stocks, or C, the account goes back up in value and the margin call disappears. That is not the case with IKBR. If you over leverage on IKBR and you fall below whatever their margin buffer is on IKBR, they will auto liquidate your account. Not fully liquidate your account, but they'll start selling stocks the same trading day. They won't give you 3 to 5 days. It's the same day it falls below their bottom line. Before any information, I want you guys to know you need to do your due diligence on your brokerage before you start using margin. All right, next slide. What's margin? This part is for new investors, but later on in the video we go over the lessons we learned and the lessons you guys should really take from my video, or else you may be down 25% on your portfolio. Margin in simple terms is a collateral loan. Your equity, which is the stocks in your account, is basically the collateral. If your account is $100,000 in equity and $100,000 in margin, you are 100% leveraged, right? But it's a two-edged sword. Your portfolio will go up 2 times faster, but when we go down, it goes down 2 times faster than normal also. If equity falls below a certain amount, you get margin called. Either you sell some stocks, deposit money, or the broker will liquidate your account. And so we went over that. Margin issues. So recently, right, in the last 1 month since February when the market started going down hard, lots of people over leverage, including me, thinking that, okay, it's a 40% yield, 6% on margin interest, so you'll profit 34%, right? We're not including taxes here. This works in a normal and flat / upward market, but when the market goes down, like recently, it seems these funds get decimated. Imagine the performance of funds that were already eroding and going down even though the entire market was going up. Before the downturn, those will especially be decimated even more. If you're a yield max, investor, some of these funds have been going down while the market was flat or actually green before, this year even begun. And so imagine how harder those funds are falling now with the market going down also. It's like throwing gasoline onto a fire, basically. We're not bashing yield max, but, I'm very familiar with them. So it's an example. And a lot of us are probably in yield max because that's a bulk of my community. People don't consider NAV erosion added on to the market downturn. A stock can pay 70% yield at $20 a share and give $1 a month. After a downturn, it can still give 70% yield, but it's $10 a share now. Now your distribution is 50 cents. The math isn't mathing anymore because your distributions from these income funds are based on the share price. So as the share price goes down, your dividend goes down also. So originally, you think the math works out 40%, 6% margin interest, but guess what? The stock price is down, so your distribution is down. So it's even harder to pay off your loan. So this is what I mean by the math is not mathing anymore. You were basing your math when everything was at $20 a share, but we're at $10 a share now. And if you guys made it this far, hopefully you guys check out my Discord. It is very informational. Like, look, I learned how to do cash secured puts from my community member Certified Freak. We're a small growing community, but we are unbiased. We have a lot of smart people in here giving good advice and information. And we aren't only focused on high yield, we focus on having a diversified portfolio, stuff like SPY, which, to be honest, if my portfolio was more diversified with things like SPY, I would be in a good position right now because I wouldn't have had to sell for some losses previously due to being over leveraged. But yeah, link will be in the description. All right, margin issues continued. There's an argument currently, right? Hold and dollar cost average because it will bounce back up. What I can say to you guys is you do you. That works for the underlying. If you hold long enough, you'll bounce back. The problem is these funds have never been stress tested before inside a correction. Things like Ulti, who has never gone up in share price, even in a good market, it makes you question people who telling you to dollar cost average, because where would it bounce back up? It never has. So you need to be very strategic if you're dollar cost averaging, especially if it's into a fund that already was eroding during the good times, right? If you were eroding during the good times, imagine what it'll do during the bad times. And currently we definitely aren't in a good time right now. When your distribution is cut in half, your 1K a month becomes $500 a month. Your original plan to pay the margin loan is now in shambles because if you focus dollar cost averaging, you can't pay the margin loan. Depending on how far your NAV falls, because distribution is based on NAV, the more you fall, the more you gotta invest. That's something to keep in mind. They say don't time and just dollar cost average, never time the market, but it's different with margin. With margin timing mattered. All it took was looking at SPY, guys, seeing the market is at all-time highs and just not being greedy, and it will save me tens of thousands of dollars. Instead of buying this dip, I sold. The good old buy high and sell low. It was so simple, guys, and yeah, my greed got to me, and well, I sold for some losses because I had to deleverage myself. It's as simple as looking at SPY, right? Not the 1 month chart. Look at the 5-year chart. I got most of my stocks in during December, and that was at the top. If you look at the chart during December, you would have seen we were at all-time highs. It is never smart to use margin at the very top of the market. If I had just told myself, all right, just take it slowly, dollar cost average super slow, and eventually a correction will happen, and at that time you can use a lot of margin. I didn't do that. It was my first time using margin too, but I guess that's an excuse. I'm not saying margin is bad, but look, timing matters. If you bought at 2021 all-in margin at the top of the market and you didn't wait for a market correction, boom, you would have been down big, right? And again, if you're a margin user, you probably would have been margin called if you were in these high yield funds. But then again, these high yield funds didn't exist 2 years ago. So here's that. Now, if you bought at the bottom, you would have been good because you rode everything up. They say you can't, time the market, but if the market starts dipping, then you could just start dollar cost averaging, like boom, right there, right there, right there, in small increments, and eventually the market would have started going back up. You would have seen, all right, we're about to hit all-time highs again, and then you would just rode the wave back up. But instead, I lump sum invested a bunch at one time, and this is hurting me bad, and this is hurting a lot of people. There's a lot of people right now that are down 25% in the matter of 1 month. We were chilling in February, we're in March, and look at us. I'm not the only one, guys. I am definitely not the only one. So yeah, I should have used margin, and you guys should use your margin more strategically, especially looking at the overall stock market. If we are breaking all-time highs and we are at the top of the market, do not go all in on margin, and please dollar cost average so you don't possibly buy this dip right here. You went all in right there, but then boom, because you got no more buying power, it dips even further to here. If you plan on using margin, you need to set strict rules for yourself when using margin. For example, using 10 to 20% margin maximum until a real crash happens, then go all out. Do not be like me and a lot of other people who are 80% plus leverage when SPY was at all-time highs. So when SPY was at all-time highs here, we were 80% leveraged already, super leveraged, and then we have no buying power to buy the dip right now. And for some that are getting margin called right now, they're actually selling as the market is dipping. It's a mindset plus greed thing, I think. Retail investor psychology. We get greedy when we see all the green and keep investing hard, but when the dip happens, we are panicking as we are over leveraged and have no dry powder to actually buy the discounts. Guys, inside the high yield and margin community, I feel like this is not talked about enough. And if I was able to read this slide 3 months ago, I would have been chilling. I would have been buying the dip right now. Instead, I didn't see this. I had to learn the hard way, but now I'm giving this information to you guys. Portfolio diversity and beta is not talked enough, and this is very crucial for margin users. Make sure you are diversified before using margin. Compare yield max or other similar stocks to the total stock market. The beta of these funds are too high. What do I mean by beta? Beta is how volatile a stock is compared to the S&P 500. You can see, VOO, right? That's the total stock market. It's up 2%. And then you can look at JEPI, it's up 1.5%. This follows the S&P 500 also, but it's a low beta. The market's, it's going up, it's going down. We're kind of in a correction right now, but this moves very slowly in comparison to our current high yield funds. Look at Tesla, it's up 4%. We can look at NFly, it's up 3%. Look at YMAX, it's up 2.8%, almost 3%. This means when VOO moves in the opposite direction, right? So let's say it moves down 2%. YMAX is my biggest holding and it'll be down way more than 2%. When these funds go up in value, they go up slower than when they go down. They go down way harder and way quicker. That's what I mean by beta. You need to compare how much these stocks, these high yield stocks, move in comparison with either SPY or VOO, and then you can see how quickly they move. Think about it. If these stocks already move way quicker than the normal underlying stock, right? And then you're using margin also, and we know the more margin you got, the more your portfolio goes up or goes down. And when you add those two together, and then you add in a market correction, you can hopefully understand how quickly your portfolio can go down, as you can see, obviously, in a market correction. And again, guys, my portfolio is down 25% in 1 month, but if we look at VOO, how much is it down on the 1 month? It is down less than 8%. So my portfolio has a beta of 3 basically. It went down 3 times quicker than VOO, the total stock market. I didn't know this. I didn't know about beta, but now I know about beta and I know to diversify my portfolio. What we learned is that if the market moves 2%, your high yield funds move 3.5% plus nearly. Imagine a prolonged down market. It would be total decimation of these funds. I was heavily YMAX and had to sell for a loss a portion of it because it was too concentrated. The portfolio was dropping way faster than I expected. Keyword than expected. I had a plan, but the plan went into shambles because everything just moved too quickly. If I had a big chunk of my portfolio in safer yielders and NAV protectors like SPY, it would have yielded less, but I would not have had to sell for losses as the account would have gone down slower. So yeah, very critical to have a diversified portfolio. Focus on beta. This correction has shown me the value in having a diversified portfolio, especially on margin. Literally having lower yielders sound bad because it means less distributions, but it would have prevented selling during a dip. Honestly, it would have been a net gain if I just bought into the lower yielders more, because I would have had more buying power, I would have had a bigger buffer, and I would have been able to buy those riskier funds during a market correction versus buying high yield in a good market and then having to sell during the down market. I literally did everything in reverse. I would have more money plus equity if I just didn't get greedy. All right, guys, this is the last slide. We didn't go too critical into each point. I'm just giving you guys a gist of it. But in my opinion, if I saw this PowerPoint at the beginning of December or at the beginning of this year, I would have been in such a good position right now. I learned these lessons, so hopefully if you guys are new or if you've never used margin before, that you watch this video and you share it, because I believe this 10 slide presentation would have saved a lot of people tens of thousands of dollars. Also not financial advice. Most important slide. You need to set rules, 10 to 20% margin max until a crash happens. Don't be all out on margin or else it'll bite you eventually. Dollar cost average slowly if it's an income fund, unless it's a safer index fund that shows growth like SPY. Do not get greedy no matter what. The biggest things probably is portfolio diversity. Do not be 100% yield max or any high yield income fund like I did. I mean, it doesn't have to be high yield. You could have bought AIPI, but AIPI, let's see how much it is down. AIPI. If you were all in AIPI, right? This is a quote unquote safer yielder. Look on the 1 month, it's down 14%. So yeah, even though this was doing good, this is down a lot also. And probably hedge your portfolio so it helps during the downturn. YMAX puts, as you can see, as the market goes down, while my YMAX shares go down, these puts go up in value and it kind of brings my portfolio to equilibrium. It beats having the portfolio constantly drop with nothing to hedge myself against. I personally don't think the downturn is over, so these puts YMAX may go, lower than 13 maybe even, and if that happens, these puts will kick in real hard. But yeah, guys, that's pretty much it for the presentation. Hopefully you guys like the video and share it, especially if it's to someone who's new to margin, because they will probably learn a lot and they'll probably save a lot of money seeing the lessons me with this presentation and a lot of other people have previously made. And the only way they can see these lessons if they watch the video. What am I doing to rectify my situation currently? Well, I'm heavy in the yield max high yield funds, but what I'm doing is I'm buying safer yielders to lower the allocations of things like YMAX in my portfolio. Buying XDTE, SPY, QQQI. You got the JP Morgans, I believe that's what they are. I even got T-SPY, which is the S&P 500 also. So yeah, I'm switching to the lower beta and I guess lower yielders, which have less or no NAV erosion. And again, diversifying should have been the first thing I did. Then I should have bought the high yield, but I did things in the opposite. If you guys made it this far, then thanks for watching, and hopefully you guys share this video. This video I feel like will help a lot of people out. Gen Z Raishiro out.